Well, brokerage upgrades continue to pour in for the entire IT space. In fact, now we have Morgan Stanley going ahead and revising the earnings estimates further for the large cap IT companies, and also they've gone ahead and revised the target price for the large cap companies. In fact, if you look at the entire IT sector space itself, the Nifty IT sector itself has hit record highs just on Thursday this week itself, and we are seeing quite a few stocks in the entire IT space giving returns of nearly around 40 to 100% itself since the March ending itself. So yes, good amount of momentum has already been there in the IT stocks, but again, brokerages continue to revise their target prices upwards, and this is also coming on the back of the HCL Tech's recent mid-quarter update. Do know that HCL Tech in the mid-quarter update has gone ahead and revised the revenue as well as the EBIT margin guidance upwards, and now we have Morgan Stanley as well as CLSA stating that they do see more momentum in the IT space. Morgan Stanley states that faster demand recovery have gone ahead and nudged them to revise their estimates as well as lift their target prices upwards. They're stating that HCL Tech's mid-quarter update is suggesting that revenue growth is likely to surprise on the upside for most of the IT companies, and they believe that the demand environment is going to do well, and also that could support further recovery, and as such we possibly may be seeing better multiples for the investors. They're stating that if you look at the overall IT space itself, well, COVID did slow down some of the decision making there, but that slowdown in the decision making was fairly short-lived. In fact, the management commentary across the board from various IT companies suggests better demand environment as well as better deal pipeline. They're also stating that if you look at the overall opportunity, there is opportunity for upside to the revenue estimates, likely driven by cloud, customer experience, supply chain, as well as intelligent operations. Morgan Stanley states that they do prefer Infosys, HCL Tech, as well as Tech Mahindra. They are overweight on all these three stocks, and within these three stocks itself, for their first preference is Tech Mahindra, followed by HCL Tech, and then followed by Infosys. Morgan Stanley states that spending led by digital transformation is likely to support growth, and that could in fact lead to a possible re-rating of the entire sector itself. They state that they believe PE multiples could stay higher than the 5-year average, and hence they have now gone ahead and revised the target prices upwards. The new target price for TCS stands at 2,500. For Infosys, it stands at 1,120. HCL Tech new target price stands at 900 rupees per share. For Wipro, it stands at 280. And for Tech Mahindra, it stands at 920 per share. And in fact, if you look at the entire IT pack, the way it has moved, to know that Tech Mahindra has only gained 50% from the March lows versus an Infosys and an HCL Tech, which has gained nearly around 60 to 80% from March lows. So yes, Tech Mahindra remains the top preferred pick between an HCL Tech as well as Infosys. CLSA also has stated that Infosys and HCL Tech in fact remains their bottom-up sector picks, and they are seeing incremental upside in the IT space, and they do expect more stock-specific moves going ahead from the current level. So yes, of course, watch out for this entire IT space. We're seeing a lot of experts suggesting a better demand environment coming in post-COVID.